Alrighty, so we've talked about should I take the job, and in looking at that we went through and we said, okay, am I qualified as an auditor? Do I have the proper training, proficiency? Am I competent? Do I have the capabilities? Am I independent? Am I able to act with ethical requirements? Can I act with professional judgment, professional skepticism? Yes, I can. Does the client have integrity? Yes. Let's talk to the predecessor auditor. What do you want to ask him about? RIDS, see you later. Let's talk to the audit committee, things we have to communicate, things that we disapprove of. Let's agree to do the audit. Let's sign the written agreement, facsimile for the engagement letter. So we've done all that. Everything's up and running. Sounds good. Let's plan. So you look in your notes, it says planning procedures. It says the planning procedures. The engagement partner and other key members of the engagement team should be involved in the planning of the audit. The engagement team plans the audit to be responsive to the assessment of the risk of material misstatement based on the auditor's understanding of the entity and its environment, including its internal control. The nature, extent, and timing of planning will vary with what? So the nature, timing of your planning. So what you're going to do, how much you're going to do, and so on varies with what? The size and complexity. This has been asked in multiple choice. The auditor's experience, like have I done this audit before? Do I understand the industry and the business? Again, the next one, knowledge of the industry and business, and then knowledge of the entity, its environment, including internal control. Early appointment of the auditor is preferred and advantageous. Okay, now at the beginning of the audit engagement, the auditor will perform preliminary engagement activities. So what do you need to do? Procedures regarding continuing the client relationship and accepting the engagement. So we talked about acceptance. Evaluation of compliance with relevant ethical. So we talked about ethics. Does the client have integrity? And then finally, should we sign the contract? An understanding with the client called an engagement letter. The auditor's planning activities applied in developing the overall strategy include identifying characteristics of the engagement that affect the scope, determining the reporting objectives to plan the nature and extent, consider other factors that the auditor deems significant in the direction of the audit, consider the preliminary activities and relevant knowledge gained from other activities, and ascertain the nature, time, and extent of resources needed to perform it. Now, the development of this detailed audit plan is called an audit program. And an audit program is required for all of our audits. In looking at this, it is called an audit plan or an audit program, which is a step-by-step detailed list of audit procedures we are going to perform. So an audit program is a step-by-step list of audit procedures. It'll say things like, and I had mentioned this memory aid or mnemonic, you perceive, and that is understandability. These are the assertions that they're making in the form of these statements. Presentation, existence, rights. So the question is, if I had to go out and attest to or give an opinion that, hey, in my opinion, internal control is presented fairly, what kind of step-by-step list would you want to follow in order to verify that? So that's what we're asking about. That's what an audit program is. So for example, here it says, here are the assertions, here are the objectives, here are the actual audit procedures. So it says, obtain schedule, foot the schedule, cross foot, which means adding the schedule, tie beginning balance to last year's ending, tie ending balance this year to the general ledger, look at the detailed audit, get a list of additions, get a list of disposals, audit the list, look at supporting documents, and so on. So there's a whole list. That's called an audit program. We're going to talk about an audit program, audit plan. We're going to cover that in detail in the audit evidence chapter. But here in the preliminary planning, we say, okay, what do I need to do the audit? I need an audit program, audit plan. It says here, it is required for every gas audit. It is designed so that the procedures will achieve specific audit objectives, which relate to the assertions. It supports the conclusion, and it describes the nature, timing, and extent of the risk assessment procedures sufficient to assess the risk of material misstatements, further audit evidence, and other procedures. Now, there's several key considerations to develop an audit program. What are they? Materiality, risk of material misstatement, which we're going to hear again and again and again, and I'll define it today and again in internal control, and the business and industry. As far as materiality, what is materiality? I mentioned briefly earlier, it's how important or how significant some amount is in relation to the whole picture. It's an amount that is significant enough to affect the user's decision. So that's significant. That means it's something we need to really consider as far as the amount. It says here, the discussion of materiality indicates Misstatements and omissions are considered material if they are expected to individually or in the aggregate influence the decision a user will make on the basis of the financial statements. Surrounding circumstances are taken into account, including the size and nature of misstatements, in making judgments about materiality. Judgments about materiality consider users of statements as a group rather than the effects of misstatements on individual users. Now, we're looking at, in yellow in the word, smallest aggregate dollar. Smallest aggregate. Aggregate means total. So the smallest dollar. So let's say, for example, materiality is identified as $10 million on the balance sheet and $3 million on the income statement. Then we're going to look at the smallest aggregate or smallest total, which in that case would be $3 million or more. So we're looking at the smallest aggregate, the smallest total. It says the auditor plans to audit to obtain reasonable assurance. So when you talk about it, it says here, look at the bullets, materiality is based on whose opinion is it? Auditors, so it's auditors' judgment. We're going to look at qualitative and quantitative. Qualitative means what element, what account, what item. Quantitative means how much it is. So we're going to look at both dollar amounts but also percentages. For planning purposes, materiality is measured at the smallest aggregate. I mentioned that. There's an inverse relationship between audit risk and materiality. Inverse relationship. Well, remember we talked about here's 0, here's 100, here's materiality, here's the scope. As your audit risk, which I'll define soon, goes up, there's more risk. That means we're afraid. Audit risk is the risk you give the wrong opinion on materially misstated financials. It is the risk that you give a clean opinion on dirty numbers, right? When you're at home and you're rolling and tossing, you can't sleep, you're stressed out. What is it? It's audit risk. So audit risk, if there's more risk, then we're going to decrease materiality, which will increase our scope prime. So there's an inverse relationship between audit risk and materiality because you'll increase the scope. So that affects your audit program, audit plan. Risk and material misstatement. Now, RMM is something I'm going to delve into in just a few minutes, but basically it is control risk and inherent risk combined. It's the risk and material misstatement. It says the auditor must also make a preliminary assessment of RMM, which is the likelihood that the statements are materially misstated, which consists of both control risk and inherent risk. Now, it defines control risk, inherent risk, IR, the risk in a material misstatement due to the nature of an element of the statements. So in other words, inherent, it means how much risk is inherent in the element. Cash. If I whip out a crisp new $100 bill, wave it around, leave it up here on the table, come back in a month, is it still going to be there? Probably not, because there's a lot of risk inherent in cash. That's why you need a lot of key controls. That's why, for example, they say cash has more inherent risk than property, plant, and equipment, because my tables and chairs are not as easy to steal. So it is the risk that's inherent in an element, assuming no internal controls. The other thing is control risk. It says here the risk that a material misstatement will not be prevented or detected and corrected on a timely basis due to a lack of effective internal controls. So inherent means, assuming there's no controls, how much is inherent in the element. Control risk says, assuming you don't have an internal control system, what are the risks that could occur? That's called IR and CR. So that is inherent risk, that is control risk. Together they make up risk and material misstatement. Risk and material misstatement, the likelihood that the statements are materially misstated, basically that the assertions cannot be relied upon. And we'll cover that in more detail. Business and industry. Different businesses have different types of transactions, regulatory environments, accounting policies, systems of accounting and record keeping, each of which will affect the audit program. So all of these together will affect the planning of it, which affects the audit program. Now, what are some of the planning considerations? What are some of the planning procedures? Planning considerations says, okay, when we're planning it, what kind of things do we need to consider? It says the entity's accounting policies and procedures, because again, we need to understand the industry and business. Materiality levels, audit risk, and especially the planned level of risk of material misstatement. Matters relating to the entity's business and industry, the methods used to process information, financial statements that are likely to require adjustments, so there might be some accounts we're already kind of planning for, conditions that may require modification of audit tests, and finally, the report expected to be issued. In other words, hey, I think I'm going to give a clean, unmodified opinion. We're going to be doing a lot more work. In the past, we've always had this problem, qualified except for, in my opinion, except for this, and that issue always exists, so we might expect that. Now, that's called your planning considerations. What about your planning procedures or the steps in planning? And in looking at this, again, I know you're here. We just started the lectures. Auditing is new to some of you. You're tired. You're cranky. Your brain feels like it's on mush. My memory aid or mnemonic for this one is what? Brain stops. So these are brain stops, which are your planning procedures. First of all, it talks about basic discussions with the client. So when you sit down with the client, the basic discussions talk about the overall audit strategy or the timing, but specific procedures should not be discussed. This is where you consider things like the audit risk, materiality, fraud risk factors, which we'll define later. The review of the audit documentation, again, what I want to do is talk to, for example, the predecessor auditor. And what I want to do is I want to look at all of their stuff from prior year. Remember the opening balances and so on we talked about earlier? So I want to look at last year's information. Now, in the real world, how do you do an audit? You take last year's work papers, you Xerox them, copy them, white out the numbers, put in this year's numbers, charge them $100,000, right? How do you do an audit? Dilly method. Do it like last year. Or Sally, same as last year, right? I mean, that's the joke. Like, here's a stupid joke. Why did the auditor cross the road? Because they did it last year, right? All you auditors are going, that's funny, right? But don't tell it to your non-accounting friends. They'll think you're a loser. Anyway. All right, ask about recent developments. That talks about mergers, product lines, any changes in the industry. Interim financial reporting. Interim financial reporting is important because with interim would be like quarterly, which we'll talk about a 10Q quarterly versus a 10K annual. Interim, you're interested because that affects the whole year. And one of the things we're going to look at is what we call analytical procedures. These are called the study of data comparisons and relationships. Analytical procedures are mandatory. They're required. You must do them in planning. You must do them as an overall review. I'll cover this in the audit evidence section. They're recommended as a substantive test of actually obtaining information, audit evidence, but they're required in planning. So at the beginning in planning, you're going to have the client give you a list of all the changes in the accounts. So you're going to look through and say, this changed by 1%, 2%, 3%, that's here's one change by 42%, that's not expected. So it helps you in planning to figure out which accounts you really want to spend more time in. That's called analytical procedures, the study of data comparisons and relationships. It's based on what we call the anticipation or expectation theory. Non-audit personnel, maybe we'll talk to people involved in tax preparation. Staffing, we want to know, again, who's going to be on the job, so that's part of planning. The other thing with staffing is you're setting up things like a budget, definition of a budget, the thing you blow every year, all right? Because every year, guess what? We blow the budget. Timing's important for things like inventory observations. The next one, outside assistance. Maybe I need to hire a specialist. Because, for example, maybe I need a specialist to tell me if the inventory is legit. I know what it is I need to do. I know what it is I need to accomplish so that I can give an opinion on these numbers. But I don't know if the diamonds are real or if they're zirconium. All right, hopefully my wife doesn't know either. But I may hire a specialist to come out and say, yeah, these are real diamonds. Now that I know their valuation, I know they're real, now I can go and do the rest of the audit. But as far as looking at a diamond, I have no idea if the inventory is legit, which deals with what? Valuation. I know they own it, I know it exists, I know it's right there, but I don't know what it's worth. That's where hiring a specialist helps you. Pronouncements, there's new ASC, accounting standard codifications that I need to follow, and I need to be familiar with those. Scheduling with the client, remember we talked about lead schedules in the engagement letter, so those are schedules the client may prepare. That's part of it. You'll see that memory aid in your notes. What is it? Brain stops. Those are called your planning procedures and planning considerations. The other thing we're concerned with is supervision. Now, we need to supervise, we being the auditor. Who is the auditor? The auditor is the individual with the final responsibility for the audit. Who are the assistants? The assistants are the personnel other than the auditor with final responsibility. So we call them the auditor versus the assistants, the people that are assisting the auditor. Now, obviously, what is our goal with supervision? You want to make sure that I'm properly supervising from the partner to the manager, manager to the seniors, seniors to the staff assistants or whatever they call them. So you want to make sure that the results are in line with the expected overall audit conclusion. In other words, the partner thinks it's an unmodified clean opinion. This person thinks it's a qualified except for. This person thinks it's an adverse. This new hire has no clue. All right? We want to make sure that they're being properly supervised so that the results are in line with the expected overall audit conclusion. It says supervision involves directing assistants in accomplishing the audit objectives and subsequently determining whether those objectives were accomplished. So what does supervision include? Instructing assistants, reviewing the work performed, dealing with differences of opinion. Now this is a big one. Let's say I'm out there to do the audit and I go, hey, I need to audit accounts receivable. I need to come up with bad debt expense. What I'm going to do is do an aging of AR. If they're 0 to 30 days old, 2% is uncollectible. 30 to 60, 5%. 60 to 90 days, 20%. Over 90, I'm going to write them off. And the partner in charge says, that's not how I like to do it. I like to take the age of my 3 daughters, I add them up, I divide by 300. Whatever percent I come up with, and you're thinking, what a moron, right? So I disagree with you, Mr. Partner, on how you're going to come up with bad debt expense. Now, it says here, how do you deal with differences of opinions? It says, what are you supposed to do? Dissenting parties should document the difference and ask to be disassociated from the matter's resolution. So here's what I'm supposed to document in the work papers. I disagree with you, Mr. Partner, and here's why. We call that a career limiting move. All right, because you ain't going to be around very long. Because in the real world, what do you do? Brown nose, brown nose. Hey, Mr. Partner, that's a great idea. I never would have thought of that. That's a great idea. Let's go ahead and do that. So there's a difference between the exam world and the real world. In the real world, we would just go, hey, okay, I'll do whatever you say. In the exam world, we're supposed to disagree with you and say, I wish to be disassociated from the resolution of this matter, and you document that in the work papers, and you wonder why you didn't get promoted. All right, so that's what we're looking at as far as planning and supervision.